So I'm here to talk about business tax changes today. I'm going to start with VAT, just a couple of points on VAT. The first point is that the threshold has increased from £85,000 to £90,000, an increase of £5,000. We've had no increase since 2017. Where the 5,000 has come from, I don't know. It's not in line with RPI, it's not in line with inflation, but it is an increase. The Federation of Small Businesses wanted the increase up to £100,000 limit. Others wanted to reduce it to make it a fairer playing field for smaller businesses. There's no right or wrong answer. The DIY house builder scheme went online last year, which enabled people building their own house to actually claim their VAT back very easily and very slickly online. What HMRC didn't introduce at the time was their ability to check retrospectively. They've now introduced that. I think that's fair enough. There's an interesting High Court case following looking at private hire firms, in particular Uber. And really what they're trying to determine there is who is deemed to be the principal. Is it the agent who books the actual trips and the fares, or is it the driver that actually drives the vehicle and collects the fare? In London, it's been determined that Uber are actually the principal following the High Court judgment, and that has an impact on VAT on fares. However, there is something called the Tour Operators Margin Scheme, which basically charges VAT on the margin only. That takes it back to where they started, albeit through a very difficult, or different, I should say, and technical route. There are further judgments expected elsewhere around the country as to whether Uber are the principal or otherwise. Moving on to corporation tax. There were no changes announced in the budget. After 6 years of a flat 19%, we're now at 25%, and you can see how the rates have changed over the last 15 years or so. But even with a 25% main rate of corporation tax, how do we compare? Well, I think it's fair to say we're certainly not the best around the globe, but equally, we're not the worst. We're in the middle there. We share a rate with France and with China, but we're more than the USA and particularly Ireland. Remember that many small businesses are making profits under £250,000 still pay a lower rate of tax. The first £50,000 of profits is chargeable at 19%, and as the profits increase, so does the progressive rate of corporation tax up to 25%, and it remains static at 25%. Where profits exceed £250,000. So what this means is we have a marginal rate of corporation tax between £50,000 and £250,000 of profit of 26.5%, which takes the overall rate up progressively to 25%. It then levels, as I say. It does create some interesting tax planning opportunities if your profitability is between £50,000 and £250,000. Associated companies. You really do need to watch associated companies. These are companies under common control by an individual or a group of individuals. The more associated companies I have, the higher the rate of tax, the quicker you get to the 25% main rate, and you may have to pay your tax more quickly as well by paying by instalments if you have many associated companies, and that has a very, very big cash flow impact. But look at all these other issues that might be affected by your number of associated companies. In particular, think about employment allowance, think about transfer pricing rules, think about the corporate interest restriction and VAT thresholds. They are split between associated companies. So moving on to capital allowances, we did have some changes, but just a quick recap of where we are. The three main rates of capital allowances for plant and machinery is 18%, for integral assets is 6%, and structurals and buildings allowances are 3%, giving relief over 33 1/3 years. Last year, HMRC announced a new relief called full expensing relief. Now, what that basically does, as the name suggests, it provides 100% of tax relief in the year in which the expenditure is incurred. It only applies to new assets, not second-hand assets, which is quite strange. Also strange is we also still have an annual investment allowance. An annual investment allowance also gives 100% tax relief in the year in which you acquire your capital spend. But annual investment allowances can be available to be used on second-hand assets. Now, what they announced in the autumn statement was that full expensing allowances were here permanently. When they were originally announced, they were only available until 2025. They're now here permanently. And what they've announced in yesterday's budget is that leased assets also qualify for full expensing, whereas until the announcement yesterday, they did not. They're still consulting on that, but that's their intention to bring it in this year's finance bill. Now, there is a choice between claiming full expensing or your AIA. Depending upon the asset you're acquiring, particularly if it's second-hand, you have a choice. If it's new, you can have a choice between the two ways to claim your capital allowances. But remember, a full expensing claim is a separate pool for capital allowance purposes. So what that means is when you come to sell that asset or you realise value or you part exchange it, you're likely to create a balancing charge because your pool will be empty because you've fully expensed all of your cost. However, an annual investment doesn't have a separate pool. It goes into the general pool. So depending upon your replacement profile of your capital expenditure, that will determine whether you have a balancing charge on its disposal or otherwise. My advice to you is to take planning. This is not as straightforward as just as whether it's new or second-hand. It's whether you need to pool it or whether you should keep it separate altogether. So take advice. This is not straightforward. Moving on just to a few consultations that are ongoing. In the autumn statement, HMRC announced measures to try and collect the tax gap. The tax gap is what they know they should be able to collect compared to what they actually collect. And they wanted to raise £5 billion over 5 years. So what they've introduced this year are consultations about more measures to increase tax transparency and the sharing of financial information and cryptocurrency both within the UK and internationally. So they'll have more power, more information to find out more about your affairs and your investments. There are also changes underway. We're waiting for new rules to be announced in respect of umbrella companies, a crackdown on compliance. These are targeted anti-avoidance schemes that have been around for some time, and we're waiting to see how they'll finally be brought to an end. And just to mention the good point at the end of that slide about free ports give great tax reliefs, really great tax reliefs. They were initially for a 5-year period. They've now been extended in yesterday's budget to a 10-year period. There are some locally within the region. If you're able to utilise those tax reliefs, please do so. It is good for the region, good for the local economy. But what I do want to talk to you also today about is research and development tax reliefs, because we have some changes there. Every year we stand up, one of us stands up and talks about research and development because it's great tax relief. It's very generous tax relief, but every year they tweak and change the rules. This year we have some quite big changes happening from the 1st of April. So claim numbers increase 5% year on year. That's what the stats show. These stats go up to 21, 22. HMRC don't have any subsequent details available at the moment, but they will be available shortly, we are told. It costs the Treasury £7.6 billion per year, an 11% increase on the previous year. It's a really big tax relief. It's a really important issue for those operating within the research and development sector. Last year, they reduced the relief. They pulled it back a bit. And this year, we have bigger changes coming into play. Currently, there are 2 types of relief. Relief for a small and medium enterprise. So a small enterprise is one with under 500 employees with a turnover under 100 million euros and a balance sheet under 86 million euros. And that's where basically your R&D spend is enhanced by a percentage and then deducted in calculating the corporation tax exposure. For large companies, we have an R&D expense credit, an RDEC, which is more complicated to explain, more complicated to understand, but things are changing. What HMRC are doing is they are basically creating a merged scheme. So they're taking away the SME rules, they're taking away the RDEC rules and creating a new scheme, but that new scheme affects accounting periods starting on or after the 1st of April 2024. So we're now upon that. What are they doing? Their aim is to make claiming the relief simple. They want one set of rules for all companies, and they want to tackle abuse within the R&D sector. And HMRC inquiries are on the increase in R&D claims without doubt. But what they've now said is that the merged scheme will follow the large company RDEC scheme, which I mentioned already is more complex to understand and more difficult to calculate. But there is a get out, because if you are an R&D intensive business, then you can still use the old rules. So they haven't hit their headline there of having one set of rules for all companies. Typical HMRC. So what does a claim look like at the moment? Well, a claim at the moment under the SME rules, basically, in this example, we have £100,000 worth of R&D expenditure, and that is enhanced currently by 86%. Until April 2023, that was enhanced by 130%. But what it really means is you get tax relief of 46.5% on your R&D spend, a very generous tax relief. The RDEC scheme works differently. You work out a 20% tax credit, and above the line you take the £20,000 off. You then work out your corporation tax liability, and you take the £20,000 off the final figure. Surprise, surprise, you get less tax relief. You only get 35% compared to the 46.5%. So this just shows that in 2 years, I mentioned that relief had gone from 130% for an SME down to 86%, and now it's going to move to the RDEC scheme, the large company scheme, from April 2024, which means in this example, that £100,000 worth of spend goes, the tax relief goes from £24,700 down to £15,000. And that's despite corporation tax rising in this period. I mentioned R&D intensive companies a little while ago. They've made some changes there to say that only 30% of your costs need to qualify for R&D expenditure in order to be treated as an R&D intensive company. And if you are an R&D intensive company, you are able to use the old rules, the SME rules, the ones that are easy to calculate, and the ones that give you more tax relief. Surprise, surprise. So we still have two R&D schemes despite their headline ambition. Other good news is subsidised and grant-funded project restrictions have been removed. That's really, really good news, because until now, if any part of your R&D expenditure had any type of grant or subsidy attached to it, you couldn't get R&D at all. Now they're saying they're restricting those, and obviously only the costs you incur, not the gross costs, will benefit, but you will still get R&D relief. And there's also been a pay-as-you-earn cap over the years, which has restricted the amount of tax credit you can potentially get back, particularly under the RDEC scheme, which was limited to the pay-as-you-earn exposure on the staff that are employed directly in R&D and only those costs. They've extended that and they've abolished that, saying all pay-as-you-earn liabilities can now be subject to repayment and tax credit. And they've also tripled that figure and added £20,000 on the top. So they have made the tax credit much more generous where it's needed. And the final point there really is just to point out, as with everything else, we've talked about the inheritance tax issues earlier, about assets being within the UK. In a similar way, to get R&D tax relief in the UK, your activities need to be undertaken within the UK. And I think that's probably understandable as to why HMRC have taken that focus. My final point is strictly not R&D, but HMRC have announced further enhancements to the relief available to the creative sector. So that includes the film, TV and theatre production works, orchestral productions, as well as museums and galleries. And the tax credit is really, really generous, but it works in exactly the same way as the R&D RDEC scheme does, as a tax credit in calculating the corporation tax liabilities. Thank you. That brings me to the end of the business taxation slot. So I'd like to now bring our budget event to an end. I wanted to take a moment really to say thank you all for joining us today, whether you're with us in person or whether you've joined virtually. Your presence has helped make this event a success. For those here in the room, please don't forget to take your Hessian bags away from you, fill them with some books and donate them to a local school or a library. It's a fantastic way to support literacy and spread the joy of reading and mark our theme today of World Book Day. Before you all head off, I'd like to ask a little favour. We'd like to improve our events wherever possible, and your feedback is incredibly valuable to us. Could you take a moment to please scan the QR codes that are on your tables? Or if you're joining virtually, you can see it on your screen. Please scan it and fill in the form. And it shouldn't take more than a few minutes, but it will help us shape our events going forward. Obviously, we have some thank yous. First of all, to all of our speakers today, to our fantastic tax team who worked throughout the afternoon, evening and into the night last night in preparing today's presentation. Our marketing team, thank you very much. And also to Trinity Park for their hospitality today. I think that all deserves a round of applause, please. Now on to some exciting updates about Scrutton Bland. We've been busy making some decisions and changes to our structure in the past 12 months to ensure we're poised for growth. As you've probably seen, we've recently opened new offices in Bury St Edmunds and welcomed Paul Harris from RSM to our partner team. Opening a new office is a significant step for us. In addition, let's not forget to celebrate, I should say, the promotions of Jack Deal, of Chris George and Stephen Burgess, who joined our partner lineup back in April. They've worked incredibly hard and we're thrilled to see them rise to this new challenge. In November, we also welcomed John Perry as a new corporate audit partner to our Ipswich team. So please stay behind and say hello to any of the partners before you leave today. If you have time, fresh tea and coffee is being served. And as for what's next, well, you'll just have to stay tuned, I'm afraid. We've got some exciting expansion plans underway and we can't wait to share with you just as soon as we can over the next few months. If you're planning to head to the Suffolk show this year at the end of May, we're pleased to say that we'll be there, as always, ready to welcome you to our stand as we've done so for many, many years. Before I let you go, keep an eye out for the follow-up email. We'll be sending out a recording of this morning's talks and a handy PDF summary of the announcements that have been made. Our website also has dedicated budget pages providing more insight and detail on the changes announced yesterday. But in the meantime, if you have any questions or want to chat further, our team and all of our speakers are hanging around after this event to take your questions. Once again, thank you all for joining us today.